Hey guys, Nick here from Nick's Taxes, and what if I told you I had an investment opportunity for you guys that had an 85% upswing in 3 years plus paid a 10% dividend yield on a monthly basis? Well, today I have a stock for you guys that does just that, and that is RioCan REIT. Now before we get started, hi, I'm Nick from Nick's Taxes. I make videos on the CERB, taxes, personal finance, and investing. So if that's of interest to you guys, please consider subscribing. And also if you get value out of this video at any time, please hit that thumbs up button. I would appreciate that very much. But in today's video, I just want to highlight RioCan and the tremendous opportunity that is in front of us right now to invest in this stock. Now, RioCan is a little bit different than some stocks because it is a real estate investment trust, also known as a REIT. That means that you're basically investing in property. It's another way to invest in real estate. If you can't buy a house or something like that on your own, you can invest in these REITs. And these REITs have certain restrictions in place that involve paying out investors on a monthly basis, and they collect their money via collecting rent. So that's how these companies earn most of their money. So RioCan REIT is mainly in the retail section, but they also have residential and other real estate in place. But again, most of it is retail. And that's why you currently see this stock beaten up so badly and have such a high dividend payout with such a low price per share. RioCan sells currently around $14. At the end of Friday, it was $14.38 with a dividend yield of 10.01%. Now, the reason why this dividend yield is so high is because they haven't cut or lowered their dividend since the stock took a big nosedive in March. Obviously, in March, when the lockdowns and everything kind of happened, RioCan was a stock that was hit quite hard, and they haven't yet recovered yet, but they haven't changed their dividend yield, or they haven't changed their dividend payout, which means that their dividend yield is quite high. And you'll see this in some other very strong stocks as well that have still kind of taken a beating in their share price, but haven't wavered on how much they're paying out in dividends. You'll see some higher yields than normal. But at this 10%, I was taking a look, and their dividend payout ratio is still around 86%, which is very healthy. It means that they're not breaking the bank to pay out your dividends on a monthly basis. So I think this dividend payout at this 10% rate is still safe. And we'll talk a little bit more about that later because the management team of RioCan also addressed that in their conference call a couple days ago, and so I will shed some light on that a little bit later. RioCan also has a 20-year history of paying out their dividends and never cutting them, which is also a very good sign of why I think this dividend is here to stay. And so once you buy this stock at a 10% yield, you should be able to get that 10% for as long as you hold this stock. RioCan also took a heavy hit during the 2008-2009 financial crisis. You can see their stock plummet. They were able to keep their dividends stable throughout that time, and they fully recovered within 3 years. And so that's why I think that even just on a conservative level, that within 3 years, RioCan can bounce back to their pre-pandemic highs, which would represent about an 85% upswing. And that's why I say I think there's a chance for an 85% appreciation, though I think there's actually more than that. So I think this is a great look because I see this stock recovering actually even faster than that. But based on the last financial crisis, looking back in history, it took them 3 years to recover and then continue on that trajectory while maintaining their dividends. So let's take a look at some positive trends with RioCan and some things that I'm excited about. One is obviously during these crazy times, they were struggling with rent collection, but with some government incentives and with RioCan investing in some solid retail companies, Their rent collection in the third quarter was actually more than 93%, which is extremely encouraging given the economic outlook right now. So they're able to collect their rents, and it's just a testament to their strong tenants. The company is also very well diversified, with no single retailer accounting for more than 5% of RioCan's revenue. And in the management presentation that happened a few days ago, RioCan's management team did announce that they were looking to increase their exposure in the necessity kind of retail stores, and were decreasing their exposure to some of those that, you know, aren't as necessity driven. So we're looking at increasing their exposure in stores like Loblaws, Canadian Tire, Dollarama, and Costco. You know, those kind of companies aren't really going anywhere and are still actually maintaining or increasing their sales during these interesting times. And they're looking at decreasing their exposure to companies like REI.UN and Moores. Those are, you know, just your retail kind of clothing stores that often people can go online for these sort of things. And those stores obviously have taken more of a hit during these lockdowns. The residential properties also, they are within these high demand areas right next to major transit routes, especially in areas like downtown Toronto. So those residential apartments and whatnot do remain in high demand, which is also a testament to why their occupancy rate is still in the 90% range. And also in the management presentation, the management team never really talked about the idea of reducing or slashing their dividend, which to me is really encouraging. What I like about that is they said they would only consider slashing the dividend if a better opportunity presented itself, in which would create more value for the current shareholders, such as maybe share buybacks. So as of right now, according from the information that they gave out last week, management does not intend to slash their dividend, which remains consistent to RioCan's long history of maintaining their dividends. What's also crazy about this is in their presentation, they actually just straight out said what a great investing opportunity RioCan is right now, and how undervalued this stock is compared to how it was in the past, and how the current share price does not reflect how strong RioCan is doing right now. And it's pretty evident right here. I'm going to throw it up here, but the current funds from operation multiple, the 5-year average was around 13.2 times, whereas right now the current FFO multiple is only 9 times. So RioCan right now is trading at a deep discount and doesn't really reflect how healthy this stock is, or this REIT is. And I just think it's the whole testament of REITs in general right now, because of all the uncertainty. REITs is one of the areas that has taken a big hit during this financial crisis and these lockdowns. But RioCan, due to the strength of their tenants, is doing quite well. And obviously, it doesn't look like investors' outlook really reflect how well they're doing. And I love how management has actually identified this through the funds from operations multiple. So that is why I really like RioCan right now as an investment. I really recommend investing in RioCan through your tax-free savings account or through your registered retirement savings account, your RSP or TFSA. And the reason is because if you have it in a non-registered account, there's a little bit more of accounting that is involved with tracking your investment in a REIT. And in a TFSA and an RSP, you don't have to do any of that, because all of your income, all of your investment income within an RSP and TFSA are tax-free. So all this accounting stuff doesn't really apply, because you're not going to pay taxes on these distributions, dividends, and capital gains anyway. But if you have a REIT in a non-registered account, we talked about dividends, but in reality, REITs often will pay out what's called a distribution. And so a distribution is a little bit different than a dividend. And sometimes a REIT will pay what's called an ROC, a return of capital. So when you get your tax slip at the end of the year, it will break down the different income that you received from your REIT, and one of them will be return of capital. Now, there's nothing that's really taxable from a return of capital while you're holding on to your REIT, but a return of capital basically means that you are lowering your cost base on this stock because you're getting back some of the capital in which you invested in the stock. So the best example for this would be, say I invested in a REIT that was selling at $10 per share. My adjusted cost base is $10 per share. But at the end of the year, when I receive my tax slip, it might have a section that has the return of capital at 50 cents. So that means my adjusted cost base is going to be reduced by 50 cents, and therefore my new cost base is $9.50. So when I go to sell my share in this REIT, say it's now, $12 a share, the capital gain is no longer just $2, 12 minus that $10 in which I paid for the stock. It's now $12 minus $9.50 because that's my new adjusted cost base. So your capital gains will be higher, and the longer you hold it, it is very possible to have an adjusted cost base of $0 because you're getting so much return of capital over the years. So that's very possible. So that's a little bit of extra bookkeeping that you're going to have to keep track of every year. And the best way to do it is when you receive your tax slip, you can take a look at your new adjusted cost base through the return of capital. Therefore, I recommend to just avoid the headache altogether. Don't even bother looking at the T3s. Invest it in a TFSA or an RSP if you have the room, and just watch this baby grow. I think RioCan is going to be a great stock to buy and hold for at least 3 years. I think it has great opportunity to earn you a 10% dividend yield now, and you can just collect that bad boy and let it grow over time. If you have enough capital saved up, you can establish a drip, which means that every time you get your dividends paid out on a monthly basis, you can buy a new share within RioCan, so you can continue to grow your investment. Or if you don't want to and you just want to collect your distributions, that's fine too. But I think this is a great way you can get 10%, a 10% dividend yield, and this stock has a legit opportunity to double within 3 years. I think this is a tremendous opportunity. I think RioCan is really strong and really undervalued, and I think you'll be happy that you invested in RioCan now while you have the chance. So I'm going to be doing that. Again, I'm Nick. I'm not a financial advisor. These are just my opinions, and this is meant for entertainment purposes only. So if you are considering investing, I suggest that you do your own research before you invest. Don't just take my word for it. But if you got value out of this video, please hit the thumbs up button and consider subscribing, and I will see you guys in the next video. Happy taxing.